How has result season been?
Yeah, if I can just say the result season this time has been very disappointing. I mean, every earning season, I'm all geared up, I'm all charged up to see what the numbers are. I mean, excited because always there is great deal of news flow. But this time around, the earning season have been very, very disappointing, and many factors, of course, which we'll discuss in this podcast. But if I were to name one single reason for my disappointment, it would be base effect.
Hey guys, welcome to the 41st episode of the Indian Market Story. As you know, we're here to talk about India's journey to a $7 trillion economy, which means a $5,000 per capita income. But that's a really far away goal. And we need to see how we're progressing towards that goal on a regular basis. Now, as you might know, India's financial calendar runs from 1st April on a given year to 31st March of next year. And 4 times in that calendar, which is every 3 months, all the major listed companies in this country report their results. What are these results? It's their earnings, which is where they've earned their money, where they've spent their money, and how much profit they've made, and much, much more detail. It's an opportunity for us to evaluate the progress of this country's economy on a more granular and consistent basis. And it's an extremely important piece of data to check and improve your investments. And we're here with our returning guest, Mr. Dipan Mehta. So could you tell us a little bit about the importance and the impact of earnings season?
Yeah, thank you for having me on your show again, Varun. And there's a very old saying in the markets that markets are slaves of earnings, which means that whatever the noise around is there about who's buying, who's selling, and the news flow which comes through from time to time, the real long term indicator of the health of the market is in the underlying earnings of the company. So, from that point of view, earnings are very important. Thankfully, every quarter we have the companies reporting their earnings, and when the earnings come through, not only do the companies report their numbers in terms of sales, profits, but a lot of other qualitative factors also are disclosed to the investors. And therefore, investors and analysts can take a more informed view of the company and its immediate prospects.
So we're recording here on the 14th of February, and hopefully our viewers will be able to see this by 16th, 17th February or so. And I mean, this information will be relevant for, good 3 months until the next earnings season.
Absolutely, yeah.
But how long is the earnings season? So how many companies report results? When does it start? When does it end? Could you give, our viewers a little bit more information on what this is?
So every listed company on the main board, not the SME, every listed company has to declare its quarterly results, and the results have been declared within 45 days of the closure. But for the March quarter, it is 60 days.
Okay.
Typically, it takes about 8-10 days for a company to kind of gather its financials and present it. So the first earnings start to trickle from the 8th or 9th of the following month. And bulk of the results, as you know, will come towards the last 2-3 days, which is in our case 13th, 14th Feb is when most of the results will start to trickle in, because that's the deadline for companies to report. And I think that this clubbing of earnings does tend to create a great deal of volatility also in stocks, because you are getting the earnings, you're analyzing it, and you are reacting to it.
Right.
So there could be, while the index may not show so much of volatility, there's a great deal of volatility as far as individual stocks prices are concerned.
So here we're talking about the third quarter of FY 2024. And so if I understand correctly, FY 2024, as you mean, 23-24 means that from 1st of April 2023 to 31st March of 2024 is the financial year, and Q3 is the October, November, and December quarter. So October, November, and December of 2023. That's the period for which we're discussing the results.
That's right. The results for that period are reported in the month of Jan and Feb up to 14th Feb.
Okay, great. So now that we've set the context for what we're discussing, how has result season been?
Yeah, if I can just say, the result season this time has been very disappointing. I mean, every earnings season, I'm all geared up, I'm all charged up to see what the numbers are. I mean, excited because always there is great deal of news flow. But this time around, the earnings season have been very, very disappointing. And many factors, of course, which we'll discuss in this podcast. But if I were to name one single reason for my disappointment, it would be base effect. So what happens is that companies are growing gradually, they're becoming bigger and bigger. And when they report their earnings, they obviously compare it with the same period last year. And because they're growing faster and faster and bigger, when you do a comparative on a year-on-year basis or on a quarter-on-quarter basis, because the last few quarters have been so good, so the base effect is coming into place, which is why when you do on a comparative, when you do comparison, it doesn't look that great. Although on a steady state basis, companies are doing well, but from an investor's perspective, for us, we want growth. And definitely, we are seeing in this quarter that growth has slowed down for a wide spectrum of industries.
Okay, so why don't we just broadly go through those industries? And there's 5 key industries for our economy that we've identified. Sorry, 6 key industries for the economy that we've identified. FMCG, that's a really good indicator of base consumption in the country. Banking and finance, because that's a really good indicator of the country's overall economic and financial health. Auto, because that's a really good indicator of consumer discretionary spending. Pharma, because that's a really critical industry that's exported and created a lot of value. IT services, because obviously it's a huge employer as well as exporter and money earner. And capital goods, because capital goods is the infrastructure and the investment of the country. So I think these 6 sectors should do a really good overall view of what's happening in the country. So do we want to go sector by sector and just broadly outline how it's been?
Yeah, that's right, Varun. These sectors altogether, I think, would cover 70-80% of the market capitalization of BSE and NSE. So from that point of view, when we discuss these sectors, you would have covered the entire, more or less the entire earnings season.
Pretty much. So let's start with FMCG. The core, from what I could understand of the results, is that there's been a slowdown in growth, particularly a slowdown in volume growth, and the value growth has been really flat. Is my understanding of the situation correct, or do you want to expand on that?
Yeah, absolutely correct. The actual volume growth has come down for FMCG across many categories. And with the exception of something like soft drinks and ice cream, by and large, we are seeing a mid kind of a single digit growth rate for a whole host of FMCG companies. But Varun, what we have noticed is that a lot of the FMCG companies have reported good bottom line growth. And bottom line growth has come because of lower raw material expenses. So a lot of the benefit of the raw material expenses reduction has been kept by the companies in their profit margins. And some of the companies like HUL, Nestle have invested those savings into higher advertising spends. But, end of the day, we need our companies to grow solid on a top line basis, because earnings growth driven by lower raw material costs can only do so much. End of the day, raw material prices cannot go even further down from these levels.
Yeah.
And you have to have the earnings top line to start driving the earnings forward.
Yeah.
Until that doesn't happen, I would say that the earnings for FMCG companies would remain to be quite slow at this point of time. Also, a lot of the categories, Varun, have become pretty much mature, and many of the FMCG companies have really gone deep into the rural markets, and that particular market also has been pretty much covered by a lot of FMCG companies. So that incremental growth is becoming very challenging for these companies. And it's not that valuations are cheap. So from that point of view, I would say that FMCG has been very disappointing. 2 exceptions. One is ice cream category, that is a company called Vadilal Industries. And second is cold drinks, a company called Varun Beverages. I think these 2 companies came with a good set of numbers. The rest of them, very disappointing from our perspective.
I think that's good. And for our viewers that want a more in-depth view on Vadilal Industries or Varun Beverages, we have some videos out right now. Feel free to go check it out. We'll try and link it over here. But one thing, we've even done a podcast on FMCG where I think you and I thought differently about the future prospects of FMCG's growth. But I want to try and circle back on that to have a final view on where we think FMCG is going to go, not just over the next quarter, but over the next year.
So that's a good thing. I think we have done podcasts on all of these sectors. So this is a good way to recap and reassess our view on the sector.
Yeah.
So our view on the sector of FMCG remains neutral to negative. I'm not mincing any words over here. And as I told you in earlier podcasts, that what drives the stock price higher is growth. And that's missing in the entire FMCG sector. I think the entire consumption pattern in the country is changing. And now the new consumption powerhouses are entertainment, hospitality, medical, spends on medical, travel, those sort of things, apparels, retail. That's where the new consumption is. And you talk about the GDP growth rate.
Yeah.
So typically, these sort of these new age, so-called new age industries, from our perspective, India's perspective, will tend to grow faster than soaps, detergents, toothpaste, hair oil.
Yeah. No, it's interesting. So I was thinking that even if FMCG continues to grow, it's unlikely to beat the pace of fundamental income growth in the country. Because sure, a company can premiumize me, right? You can add more and more premium products and I can buy those premium products. But I'm never going to buy premium products at a pace that's faster than my income growth.
And population growth also, no? Because end of the day, these are personal consumption products. So if population is growing at 1-2%, how much can you expect the volume of these companies to grow?
I think the only maybe googly in this would be is if somehow the FMCG companies manage to convince a larger segment of the population to invest more heavily in personal health and hygiene products and stuff like that, like things like toothpaste, soaps, shampoos. They're available everywhere. They're not used as frequently at the top of the income pyramid as they are at the bottom of the income pyramid. If that changes, we may continue to see some volume
I
growth.
think that's the aspiration of all FMCG managements. And of course, they want to take you up the value chain.
All right. So let's move on. Let's move on to one of your pet industries, banking and finance. How have their results been?
It's my pet industry, but I'm really disappointed with the numbers. Be it HDFC or ICICI or even NBFC like Bajaj Finance. I mean, numbers are okay. Nothing to, kind of startle you and, energize you that, okay, I'll increase my exposure to this sector. And the real reason for that, Varun, is that liquidity is tight in the market. RBI has been consistently trying to follow a tight liquidity policy, first by increasing interest rates and thereafter sucking liquidity out because they want to keep inflation under control. Right now, we are still at about 5% there about inflation. And ideally, they want to bring it to 4% or below. So liquidity is tight. And liquidity, as you know, is the real raw material for these lenders, these credit companies, banks and BFCs. So if liquidity is tight, then they are paying a higher price for the money that they borrow. And also, they're not able to then grow as fast because they don't have enough of firepower to grow their lending book. So that's what's affecting these companies. And what the common thread I saw is that the pre-provisioning profits, which is before you make provisions for bad debts, that has flattened out. So it's like low single digit, lower than last quarter, 10-12% type of growth. But the bottom line growth has come because the provision amount is lower, significantly lower, and that will not last. Provisions also will start to inch up, and base effect will come over there as well.
Okay, let me slow this down because that was way like I barely understood. If I barely understood, the viewers definitely didn't understand. Let's go way slower.
Sorry for being so technical, but we can go ahead. Yeah,
so provisioning is basically bad loans, right?
That's right.
So when you say pre-provisioning loan growth, pre-provisioning bottom line growth has gone up. That means before bad loans, the profits are going up.
Let's reboot.
Yeah.
So typically think of a bank or an NBFC, they're borrowing money at interest rates 7-8% and they're lending it at 10-12%, 18%, whatever. So what their borrowing cost and the lending their borrowing cost and lending cost is the profit, which is the revenue which they earn.
Net interest margin.
So far so good. Net interest income is the net interest income which they earn, what they earn minus what they pay. So the net interest income is flattening out.
Okay.
The net interest income is growing at 8-10% or thereabout. Then their expenses are there, personal expenses, technology expenses.
Sure.
So those expenses also have gone up because of inflation. And therefore, after the net interest income minus all their administrative costs, we come to what is called as the pre-provisioning profit.
Okay.
PPOP, technical term. So the pre-provisioning profit is stagnating, has flattened out when you compare it with the last December quarter. But the actual net profit of the companies has gone up because after this pre-provisioning profit, you have to make the provisions for bad debts. And thankfully for India, the NPA cycle, the bad debt cycle has not worsened at all. It is pretty much stable. So what they are doing is that their banks and NBFCs are making lesser provisions because bad debts have gone lower. Fair enough. But how much? So the provisioning which they have made is coming to very, very minimal or base level. But when I look ahead 1 year from now, when you go to December 24, the provisioning is not going to remain as low as it is because their lending book also has gone up. So provisioning costs also will go up.
So bad loans will go up.
Yes.
Okay.
Just normal business, nothing unusual.
Normal business size, the bad loans will go up, they'll go down, they'll go up, they'll go down. Right now they're down, later they'll go back up again.
But a very important point to note over here is that when we analyze banking companies, we are very keen to know what is the growth of the pre-provisioning profits. Has that gone down or gone up? And in this quarter, across the board, lenders, we are finding that their pre-provisioning profits certainly has slowed down. Few exceptions, only two, Varun. I think ICICI Bank is an exception from the banking side, and Bajaj Finance and Cholamandalam are the two exceptions where their pre-provisioning profits also have remained pretty strong. So one needs to make a note of that.
Okay. So I want to try and stick on HDFC for a second because I have some numbers. The year-on-year profit is up 34%. And their Net interest income is also up 24%. Uh, and somehow I'm not able to make this.
So you haven't looked at the pre-provisioning profit. That would be significantly.
Okay. So
that
this is
growth-
all mostly just the provisioning effect.
Yes.
The pre-provisioning profit for HDFC Bank has been flat.
flat or low single digit, if I would
Got
say
it.
so. And that's true across the board, and more so with PSU banks also, which were the darlings of the market. There
Right.
also we have noticed that these pre-provisioning profits have kind of stagnated. In India, 8-10% growth is stagnation.
Yeah.
mind you, huh?
No, I understand. I understand.
Yeah.
I understand. So I have a follow-on question with this, right? You mentioned that the core problem for banks is liquidity is tight, and therefore they are in the position that they're in. Um, Over the next year and a half, 2 years, I think Fed interest rate cuts are baked in, right? That's to come. And as that comes, one would expect, you know, RBI might also decide that they want to cut, 50 basis points, 100 basis points over the course of a year or 2 years. So a year from now, do you see the situation for banking and finance companies improving?
Absolutely. Varun, you and I are both very bullish on India, right? And if you're bullish on India, you can't be bearish on banks, because banks and credit industry are the ones that grease the wheels of the economy. So if industry is doing well, personal consumption is growing gradually, big ticket items are being purchased, real estate is doing well, auto will do well, then banks and NBFCs will also do well. It's just, I think that there's a transient moment in their journey where they feel that because of tight liquidity conditions, they're not able to raise deposits, and they have had to raise the interest that they pay on the deposits, and that's being seen in the results. So it's not that the prospects have become bad. Same with NBFC. It's not that, see, I would clarify that although I'm disappointed with the earnings season, it's not that the medium to long term earnings growth have been compromised.
Okay.
So we need to put that perspective.
Yeah, that's an important perspective. So I guess I'll ask a follow-up question. Given that the results have been a bit of a disappointment, have the stocks performed badly? And is this a good moment to add more?
And we'll take that question for another time, because the thing is that stocks have not done badly because a lot of money flow is coming in, and I think that still we are analyzing the numbers. They've come in so thick and fast. So still, I think it's not yet completely sunk in. But from whatever I've seen and whatever reports I've read, many earnings are being downgraded more than they are being upgraded, and
Okay.
eventually that will reflect in the stock prices.
Okay. Let's move to something that's not India focused now, IT. It's a great employment generator and value generator, but it doesn't derive much revenue from the India growth story. So how has their results been, and what's their outlook going forward?
So I think software per se, there were very low expectations in the market. And that's, if I can just say one line, expectations also play a key role on how the results are received. And largely the expectations for IT industry were very low. And these companies just about met or slightly improved on the expectations, which is why stocks like Infosys, Wipro, HCL Tech rallied a little bit after the numbers came out. But end of the day, when you do a comparative analysis, it's still pretty much stagnation for these companies. And they are, of course, faced with a lot of macroeconomic factors and headwinds over there. Sure, I think after the Fed announcing that they're not going to increase any interest rates, and you can expect 3 to 5 interest rate cuts over the next 12 months, the sentiment in the US economy, European economy has improved. And also the kind of engagements with software companies that their clients have had has improved. But it's yet to reflect in the numbers of these companies. And December typically is a kind of a seasonally soft quarter because of holiday season. So there are a lot of furloughs also. So all of these put together on a kind of a stand. I mean, if you just analyze the numbers, then quarter on quarter, year on year, they have been largely disappointing. And if I may add that some of the hot mid-cap software companies like Persistent Systems and even Coforge, Emphasis BFL, they have slightly disappointed me. The growth rates are good, but they were growing at 35%. They're now growing at 15-16%. Same with Tata Elxsi. Only exception in the entire software is KPIT, which grew exceptionally well and now is an absolute top performer in the software industry.
Why?
They make software for autonomous cars and EVs. And over there, I think there's a disruption taking place in that particular segment. So those companies are not cutting back on any software or technology spends.
Okay.
So by and large, I think it's been disappointing. But I would say that again, this is transient, because once tech spends start to pick up globally, immediately these companies will do well. And I just want to add over here that while the companies' reported numbers were disappointing, as they have been for the last 2-3 quarters. Gradually, we are seeing their billing or the order book position improving pretty well.
Okay.
So it's just a matter of time before these orders start getting converted into revenues.
Okay.
And as and when that happens, you may have a surprise coming in from the software companies.
Okay, that's good. That's good to hear. So I guess I'll ask two to three key questions here because we did a podcast on the IT services sector almost a year ago. Two questions. First is, we thought that the outlook for the IT services sector for the next couple of years would be a little bit damp because of economic challenges, but also because of base effect, because of these companies are now very large. And we said that the value is going to come from small niche mid cap players. Is that view still the same?
That's right. I'm still very positive on small mid cap companies, and they have really found their place in the sun. They have created their niche, and you'll be surprised to know that for certain projects where they have a very specific skill set, large MNCs also are going to them. So I would still place software through mid cap, small cap software companies, but as of now, even they are feeling the pressure of macroeconomic headwinds.
Okay. All right. Fair enough. So let's come back to our original area of focus, the India story. And let's talk about the auto sector. Great indicator for consumer discretionary spending and broader consumer expenditure. How have their results been?
Good. I mean, it's good numbers. I mean, while we've been disappointed with a whole host of sectors, I think by and large auto did well, and two reasons for it. Because first of all, the volumes were strong for the auto industry, and that's again because last 4 or 5 years the auto industry has been undergoing a lot of challenges, and there were regulatory changes. There was the semiconductor supply problem. So there were problems in terms of volume growth, and there was a huge pent up demand. And last 2-3 quarters, we've seen that pent up demand has generally pushed the volume growth for these companies. Also, there's a super premiumization trend taking place in the auto industry. So the average selling price per vehicle is going up gradually for these companies. And the last and the best thing is that the raw material prices, steel, aluminum, they remain pretty much flat to declining. So the operating profit margins also increase. So I would say that this is really blue sky scenario for a lot of the auto companies. But at some point of time, I think we are going to see their base effect start to catch up in the next 2-3 quarters or so. But by and large, I think it's a sector investors can remain overweight in. There were very minimal misses over there, and companies like TVS and Bajaj Auto, they really, really surprise investors on the positive side.
Okay, all right, interesting. Let's move on to pharma. Pharma, I want to do relatively quickly, and we'll spend some time on capital goods. So, pharma, how has things been?
Again, pharma, second industry, I would give it, which numbers have been exceptionally good. And they have been good for the last 2-3 quarters. The reason for that is that, first of all, Indian pharma sales, domestic pharma sales, have kept up pretty strong. They're in that 10-12% type of value growth, which is driving the pharma industry pretty well. The government has been a little bit slow in terms of putting more and more drugs into price control. And wherever there were price control because of high inflation, price increases have been granted to the pharma companies. But the real trigger for improved earnings has been stability in prices in the US generics market. Last 3-4 years, we have seen sharp declines in US generic prices because of intense competition. But now that seems to have got leveled off. And as and when these companies have been launching new molecules over there, they've been getting the benefit of higher revenues as well. And again, raw material costs have been lowered because basic chemical prices have come down for pharma companies. So we are in this super position again for pharma, where top line has done well because of the factors I described, and bottom line margins have gone up because of lower raw material costs.
So there's something I'm trying to understand here. So so far we've done FMCG, banking, auto, and IT, and everything here has been driven by the macros to some degree or the other. Pharma, my sense is that doesn't really seem to be the case because you've not mentioned the macros even once here.
It's a defensive industry, Varun, that's why.
Okay. So we should completely disregard macroeconomic circumstances when discussing pharma.
That's right, but then as I said, the US generics market does get driven by the competitive intensity, not the macros.
Okay.
Because healthcare spends you will never compromise on. If you are sick, you have to spend it whether your income is up or down. And a lot of the healthcare spends are being funded by the government, and the government's not cutting those expenses because it would be extremely unpopular. So pharma is in a unique position, and it was under stress because of the export markets and tender prices not being under pressure. But that particular thing is gradually improving. And mind you, there are some amazing entrepreneurs in the pharma industry. So they really drive the sales. They do innovative things. Go to new markets, new products, better R&D, specialty products, something or other they're always trying to create value for the investors.
One thing I like about the pharma sector, even though unfortunately it's a sector that I really don't understand.
Nobody understands it.
Nobody understands
because you cannot pronounce the products, the names of the products. Yeah.
I think pharma is one of the few sectors in this country where India is a global innovation leader. Like if you think about all the sectors we've discussed so far, the only sector that I can with confidence say is a global leader in terms of innovation is pharma.
Innovation on the cost side, not on new chemical entities. So we innovate a lot when it comes to the processes to reduce the costs and more backward integration, and therefore lowering the medical healthcare costs for the global economy by setting up world scale plants and then getting them audited by the FDA and coming out pretty decent over there. But new chemical entities is still coming from US and Europe by and large.
Okay. All right, but still, if you compare,
it's a success story of India like technology, no doubt about that.
Yeah. All right, so let's move on to our final sector. Something that's quite interesting, and I want to spend some time discussing is, capital goods. How have capital goods performed this season?
So capital goods, I think, mixed kind of report from the capital goods industry, and in this sector, one cannot really paint all the companies with one single brush. There have been disappointments. I thought Larsen & Toubro's numbers were slightly disappointing, and they claimed it because of legacy orders. But what I noticed is that a lot of road and irrigation construction companies, although the numbers were okay, their order inflow has been slowing down because the government has been slow in releasing orders because of issues with NHAI, and now they're entering into the election season. So there could be a slowdown in orders over there. The street is recognizing that while the numbers may be good, but what really drives the stock prices of capital goods companies is the order inflow.
Right.
And order inflow has been slightly tepid for many companies. Not across the board, I wouldn't say so, but for many companies it has been a bit tepid. And also largely, the gains on account of lower costs are not as much visible over here because these companies work on very low profit margins as well. And interest cost, working capital also plays a key role. So I've just been kind of mixed set of numbers. And if you don't mind me extending, I think there's one industry we have missed out, that is cement.
So before I get to cement, I have a few more questions on capital goods. So you pointed out interest in working capital considerations as a key driver. As interest rates come off over the next year, do you expect this to recover? Do you expect this softness to be temporary?
No, I think what is happening also, another very strong trend is that a lot of the engineering construction companies, they are steadily improving their balance sheets and reducing their debt. So the alpha on account of lower interest rates will not be as much. What really is going to drive the sentiment in these companies is order inflow. Okay. And that's not going to happen until after the election. So I'd be a bit cautious over there as a matter of rating.
So let's talk about order inflow for a second. Because we've seen the last quarter, there was a lot of data about the private capex cycle sort of revving back up again. Would that not feed into better order flow through the year?
It would, but the government orders are the ones which are really massive and drive the industry per se. And across the board, I think even for PSU companies engaged in engineering defense, the order flow has been tepid. And end of the day, these companies, the best quarter, again seasonally weak quarter, the best quarter is Jan, Feb, March. So 40-50% of their profits come in that particular quarter. So from that point of view, it's not really an important quarter, but I do track the order inflow and I'm not happy about it. Yeah.
Right. So you want to talk about cement. Let's talk about cement.
That's right. It's another important industry which is closely linked to infrastructure. And what I've noticed over there is, again, the bottom line has come through for a lot of these cement companies purely on account of lower input costs, especially transportation costs, power and fuel. That's come off significantly, and therefore I would say that the EBITDA per ton for the sector has been at near all-time highs. But volume growth, again, disappointing. Hardly any price growth as well. So I don't know how long lower costs of power, fuel will drive the earnings for these companies. because they're manufacturing and industrial companies. End of the day, they need the volumes to grow, and volume growth has been again sub 10% for many companies over there. There are a few exceptions, no doubt, but from that point of view, I'm a bit cautious on cement also. And it's not that these cement companies are trading at cheap multiples or that they have very high return on equity. And as we had discussed in our podcast that time, the entry of the Adani Group by acquisition of ACC and Ambuja has shaken up the entire industry. And now it's like every company over there wants to grow their capacity by 50 to 100% in the next 3 to 5 years. And that can never be good news from the point of view of investors, because it could lead to a glut situation.
Okay. So if I was to consolidate everything you've shared with us today, it seems like this has been a disappointing earnings season. Across the board, for most industries, earnings have been weak, but we still believe this is transient.
That's right.
And this is almost the impact or a precursor to a slight global economic slowdown that we're seeing reflected in the earnings, but in a year or two, we expect it to recover.
That's right. See, there can always be a quarter or 2 quarters of softness. As an investor, long-term investor, you have to account for such volatility in earnings. It's nothing new. But at this point of time, unfortunately, stock prices also have gone a bit ahead of themselves. So what typically happens in the earnings season is that you always do a reality check. So this is the company's stock price. This is the quarterly numbers. It's not looking that interesting or that encouraging. What is its trading multiple just now? You do that check always. Every analyst, every fund manager will do it. And when you do that profiling, that risk return profiling, the valuation matrix compared to growth rates, you will find that stocks generally are expensive for the moment. No doubt, long term is great. Long term earnings growth also be good. But for the time being, I think the stocks are a bit expensive when you compare the growth rates which have been seen in this quarter.
Fair enough. And I think that's important for investors to sort of hear. So if you were an investor sitting on cash, what would you do? And if you're an investor sitting on stocks, what would you do?
First of all, don't stop your SIPs. We have to keep on telling
you
that
have
to all
to, you have to keep the SIPs have to keep going.
Because those are the ones will ride you through these. Because I cannot tell when the earnings season will start looking better as well. So don't stop. I think I would say that from if you are sitting with cash in your portfolio, I'd wait for a correction and look to buy maybe a few weeks or months down the line when valuations are a bit more cooled off for point of view. If I'm more or less fully invested, fresh cash flow, fresh savings, I wouldn't deploy in the market. I put them in income funds, where if there's a cut in interest rates, then certainly you'll get maybe slightly better returns over there, and try to trim my positions. So what, as a thumb rule, what I do when we spoke about all of those portfolio management podcasts is that on a disappointing number, I'd look at that company very closely and recheck my logic of investing in that company. And if I feel that in the last several quarters it's been lagging for some reason or the other, then maybe exit the position or just lighten up over there. So this is it's going to be this particular earnings season is really a test for the investor, that you need to make intelligent changes in your portfolio so that you can gear up for what I think is slightly challenging times over the next few months.
All right. I guess on that note, we'll close the podcast. Thank you so much for joining us, and please do apply the advice to your portfolio. We're confident it'll add something to your returns.
So there's a director's question. You asked the first part of my question, which I was going to ask, like, should we keep doing the mutual fund SIP? So thank you for that. But another question is, like, a lot of people are talking about a crash that might occur in March or like end of April. But India's story seems strong currently because of some upcoming election in India and strong BJP position in India. Names like Robert Kiyosaki and other big names spoke that a big crash is down the corner, and it's thoda sa superstitious, but 2000, 2008, 16, and now we are in 24. So 24 might be a big crash here, according to that. So do you have any view on that? Like, is there a big correction?
Just before we get into that big correction thing, right? India's not in a good economic position primarily because of the BJP. India is in a good economic position because of its people and because of the accumulated efforts of the population over more than 80 years, 80-ish years since independence. The fact that we have great entrepreneurs in IT, great entrepreneurs in pharma, great entrepreneurs in banking, startups, that's the reason why we have these companies. The reason that we have, strong savings is the savings ethics of the Indian people. The reason we have, activity, business activity, employment is because we have a young educated populace. Okay, the government has done a lot. Previous governments have brought in FDI. This government is making infrastructure expenditure. There are digital platforms. the government is part of the story, but let's not position it as the economy is doing well because of the BJP. The economy is doing well because of the people. The government's adding something, but we're doing this first. Sorry.
I have a slightly different view over here that BJP has done many things like GST, stability in taxes, and overall government spends have gone up and they have provided impetus to the private sector. So they have played a critical role. I mean, I've been watching governments for last 30, 40 years and I've never seen such a proactive government in place. So I don't completely agree with your view. And coming to your question, a crash can never be predicted. There has to be a trigger, and that trigger we don't know what it could be. It could be anything out of the blue, geopolitical events, spike in oil prices, some country or a big company going into liquidation. So we can't predict that. All we can say is that looking at the way the earnings growth are, there is a mild slowdown, and stock prices are ahead of that. So we need to just be a bit cautious from only that point of view.
Okay. But long-term growth story is still strong.
Absolutely, without doubt.
That's it from my question.
This podcast is produced by Elixir Equities Private Limited, a SEBI-registered research analyst. Registration number INA 0000004787. The information provided in this podcast is for educational and informational purposes only and should not be considered as investment advice. Investment in securities market are subject to market risk. We strongly advise all investors to read all related documents carefully before investing.